You're listening to Inside Real Estate, your source for all things mortgage and real estate related. The show that brings you all the hottest topics and insights directly from those who know it most. Now sit back and enjoy the show.
What's up, everyone? Welcome to another episode of Inside Real Estate. You've got myself, Paul Apostolakis, Brad Weisgerber, Salvatore Cusmano. For those of you that have found us, thank you and welcome. For those of you that have coming back, thank you for listening and being a part of our show. Please go to irepodcast.com. You can go to Facebook.com/IRE podcast. You can go to YouTube. You can find us there. You can find us on any podcast app. Please like, share, subscribe, and leave us a review if you do so. Please, it does help our show. Good morning, boys. How are you?
Good morning.
Yeah. Good. Yeah, so I banged through that today. I'm super excited. We've got a really smart guest, Bill Dallas. He's the president of Finance of America Mortgage. This guy's got a really, really awesome background. Just to give you some background on this guy, he started a company called First Franklin and Ownit Mortgage Solutions. In 2009, he purchased Skyline Home Loans and with Upfront Ventures. He's really good at modernizing a traditional mortgage business. In 2018, Skyline was purchased by Finance of America, and today he leads the combined businesses. He's done a lot of good stuff, man. And he started First Franklin from the ground up. I'll tell you from experience when competing against First Franklin, they were a great company. So he ran a really good shop. Do you remember First Franklin, Sal? Did you ever go up against them?
No, I don't.
Okay, so I had a shop that used to use them, and they absolutely loved them. They did really good stuff. So without further ado, I want to bring Bill on because I don't want to waste too much time. I want to pick this guy's brain. Bill, welcome to the show.
Good morning.
Hey man, how are you? I've admired you guys. Congrats on growing a brokerage and figuring out how social media can really maybe drive some traffic.
Yeah, I mean we're trying to do everything we can, Bill.
No, I'm with you. I started just like each of you.
Yeah, I love it. So Bill, tell us about. I mean, your past is obviously very storied. You've done a lot in the business, and obviously it got you to where you are today at Finance of America. Your past is pretty storied, so we can go into that and people can look that up. But more than anything, I want to know about your role today. What are you doing today at Finance of America, and what is it that you're focused on?
Yeah, I think the past is a precursor really to what I'm trying to do today. And obviously, like you and I were talking before, interest rates have driven some behavioral change, right? And so what you said, Paul says to me, I got in the business in 2003 and interest rates have basically continued to go down. Well, my industry, I started when it was 20 and now it's 2, right? So I think the pivot is really where we're going to be focused on what happens at the nadir where rates hit the bottom. You got the Fed tapering, probably announcing tapering today.
Yep.
And you're going to see mortgage brokers run all over the place, right? And mortgage banks run all over the place to try to figure out what to do next. So, and it's not a good strategy to sort of react to what's happening in the market. So at Finance of America, really, it's about product. And it's about product, technology, making it easier for consumers. I've spent my life in the business creating technology solutions, creating products that get people onto a mortgage that don't normally fit. And I think the interesting thing is that guidelines and rules haven't changed for 75 years. In fact, all of you guys say the same thing. Files have gotten fat, processing's gotten slow, underwriters take too much time. They act like little hockey goalies at times, right? Where you try to shoot a condition in there and they block it back as fast as you shoot it in there. So I think it's a little bit about trying to bring some sanity to income and assets so that people can take advantage of the opportunity.
How do you do that?
Well, you've got to securitize, right? The number one thing is, and so at Finance of America, one of the reasons why I came over was that they already securitized. So if you think about that, the one thing, mortgage banks are takers of agency stuff.
Yep.
Right. I've spent 25 years never taking agency stuff. So how do you do that? right? So you have to have a team on top or side of capital markets that can securitize. We do about 20 to 25 securitizations a year. Of those, we have about 150 investors, and those investors buy our stuff. And so we dominate the reverse business. We're one of the top few in fix and flip and doing that. And we're now bringing that expertise to what I'm going to call our industry, right? Which would be flex. And I think flex is really our ability to try to take income and assets and build a set of rules for the modern borrower. I think the borrower's somewhat been left behind. Non-QM is sort of a frenetic. I hate the term. I don't like prime versus subprime. You guys know that. You get a customer just walks in. They have no idea what they are. They just have a low FICO or they have a high FICO. Their income's screwy. They've just got divorced. They had to sell the house or whatever the issue is, right? So you have to build sustainable guidelines. And then you have to get investors to agree to those guidelines. Right. And then you have to hold loans. The hard part for non-banks like us, take any of them, right, is how do you build a shelf and be able to do that? And we're able to do that.
Now,
how long do you typically hold a loan? Or I guess when you first started, how long were you having to hold loans for to show performance before?
Yeah, good question, Brad. There's two things you have to do. Right. One is you got to have enough size. So the question of size really is how much do you have to securitize a deal, right, to get it done? And then you've got the internal things of holding it. So once you put the structure together to hold it, you got to make sure that the customers keep paying because you can't sell a loan that hasn't paid.
They got to pay.
So the shorter you can, but it's not a pretty sight.
Right.
But what you do is you compress the time. So you've got to have volume. And today's volume to do a deal, I'm guessing that I don't see many deals getting done that are under $200 to $300 million in a pool of loans that get sold. So you've got to have enough originations to actually accumulate that amount. And then the interesting piece is that the data that comes out of the LOS engines and the stuff that you guys put together and the stuff that we gather at funding and all of that stuff you have to have a tape of information that's consistent. And that's a hard thing to do in mortgage because mortgage is sort of haphazard and the deal's closed, but there's a lot of information that you have to have post-closing that has to go into the securitization, right? First payment, where's it go? You have to make sure that the principal amounts are correct. You have to have borrower address. And sometimes those things just don't fit.
That's interesting. And, did you guys run into liquidity issues at all during COVID? Because
no, I mean, we spent a lot of liquidity. I probably invested about $100 million in March. We had margin calls of close to $100 million.
Wow.
And we have we're a public company now, but back then we've always been a very well capitalized thing. We're sort of built by a series of 16. We're Finance of America is a company that's built by about 16, 17 acquisitions. And so, and we were backed by Blackstone initially. And I got a gentleman by the name of Brian Libman, who I've known for a while. And so when you put that group together, we had enough capital to sustain that at the time, but it was Freaky Friday. In March of 2020, right? And then I get calls. I mean, I know whether it's Casey at Movement or Willie at Home Point or Matt at UWM, you talk to all these people. We were talking a lot, as owners and operators, just to say, what are you seeing? What's happening? And then you've seen the resulting 18 months or so, right? It's been like a wild ride.
It's been a wild ride, yeah. And with you guys at Finance of America, you guys have a lot of different channels: consumer direct, wholesale. Why go the multi-pronged approach in your business right now?
Yeah, so There's two things. First, you're right. Our model is much different. We have an unparalleled advisor network, which I include brokers in. So I've got brokers, online, consumer direct, and then our direct retail. And in retail, you have both traditional retail and then what I would call a version of store-owned brands.
Right.
We probably operate another 50 brands within our organization as well. And I think the main reason is the cyclicality of mortgage is what we're trying to insure around. So I want to be in all channels. I want to be able to have servicing. I want to be in reverse. I want to be in forward, and I want to be in fix and flip. And we also have a fulfillment business, and we securitize. So what happens is we're trying to build a company that can withstand anything. I'm tired of the interest rates go up. I move the deck chairs to the other side. Everybody gets thrown off. Everybody has to figure out what they're going to do. And I wanted to be consistent with our ability to actually sort of motor through whatever happens in mortgage. And I think our view is, and the one sort of tweak this time is the traditional model I think that you guys do and that almost all advisors do is transactional. We talk relational. We want to retain the customer and we want to do all this stuff and all of that. But basically we get paid everything at closing, right, on one deal.
Yeah.
So our goal is how do we extend that so that it is a relation, and so that you have to have longer term products and other products and services that you allow each of you guys to offer to the customer. And that's the journey that we're on right now, right? And I think some people have thought that, and I've heard this forever, that brick and mortar is over. You can't have a branch. You should go online. Our view is that you make every loan officer and a broker a Quicken. They should be a call center. Right. They should be able to meet the customer wherever the customer and however the customer wants to roll. But I am convinced that if you are going to buy a home or you're trying to figure out what to do with your equity in that home, that we're the best bet. And we have to build an advisor network that takes advantage of that. So we've got to have a few other products.
How many products do you guys have right now?
Oh my God. I'm going to say I'm going to go the other way. All of us have a 30-year fixed rate mortgage today.
Sure. And
then we try to do something with a 15-year that nobody takes, or a 20-year or something else. Right. And then we have some bullet that some 5 or 7 or 10-year or something. Yeah. That we offer that nobody takes because the yield curve doesn't support that.
Correct.
So we do 30-year.
30-year mortgage.
And we got everybody's doing 30-year, and we've got 500 investor types to how to underwrite a 30-year loan, which is just, I think, stupid. I would rather have one loan that does 500 things than 500 investors trying to do one thing.
It's like the Swiss Army knife of loans, right? You just 30-year mortgage that opens up and does a whole bunch of different stuff.
And I would ask you guys, a 30-year loan, when I started in the business, really lasted. We priced it off of 12 years, a 12-year prepay speed. Well, how long does a 30-year loan last today?
18
years.
18 months.
18 months.
I was say 2 years, maybe.
Yeah, we price it off of 4 years, and we get our butt handed to us. Right.
That's because of the interest rates, though. It's the interest rates. To your point at the beginning of the show, interest rates have gone down year over year over year over year for the last 10 years. So at some point, that's going to turn around.
Servicing portfolios are going to be much more valuable.
It's going to pay off.
Yeah,
well,
servicing
you think
portfolios.
They'd be valuable, but the other thing is most consumers who received a loan have figured out that they need to use the equity for something as well. So you're going to shift. Your refis just shift from rate and term to cash out.
Yeah.
Right. They go slower because we know that when the cash out loans we don't know the intent of what the borrower is doing with the money. So that's why they perform worse. Consumers just do whatever the hell they want. Your job is to put them into sustainable home equity right? But you've watched consumers. So, and they don't, but you've got gargantuan amount of equity in America.
Gargantuan.
I mean, it's
right
historic.
It's massive.
So, Brad, when you look at it, right, interest rates may go up, but I can also make a case that interest rates could go down.
They could.
It could go
That'd be
to
a hard
zero.
case. That'd be a hard case to make. I don't know how much further they can go down.
Well, we didn't think we'd need.
You got 35 countries at zero.
Yeah, that's a fair statement, Bill. That's a real thing, and people don't see that. But yeah, that's real.
And you're no longer America. America's not an island.
No.
Right? America is global. So my fear is that you're sort of at that tipping point right now, right? Where you guys would have never said you could have a two handle.
No, for sure. Agreed.
And you'll never say that we'll have a one handle.
You're right.
And you'll never say that, who knows? But if we don't fix the economy and the economy isn't sustainable, then we've got issues, right? And those issues can only be ameliorated. I mean, look at Japan. We are more like Japan, Europe,
correct,
and Switzerland and those countries than we are, I'm going to say, China, India, the BRIC nations. So when you look at and so I caution our team to just be really careful about hedging interest rates, what we have to do. The real challenge is that as home prices go up, borrowers get left behind.
Yeah.
And that's what's happening today, right? You only, and then you've had the pandemic, you've got people with job interruptions, right? So you've got all these different things that happen. So how do you get that customer on?
Yeah, it's interesting you say that, right? Because I would say that the challenge in, a buyer's qualifications today aren't necessarily DTI with the low rates, right? It's
for sure
assets, right?
Well, I think it's if you look, we built the model on a primary occupant borrower, generally a male, right? The guidelines were built around a primary occupant with a spouse.
Yeah.
I don't see that. And nobody was self-employed.
Nobody was self-employed. Yeah.
They all worked for you guys are in. Everybody's in Detroit, dude. Or they're at Chrysler in Cleveland, or they're in Ohio in some parts thing that we all made right when I was growing up. So I think the only entrepreneurs I knew were newspaper boys and girls and farmers.
Yeah.
And everybody in my little town was a farmer, and they all basically figured out how to raise a cow, take it to the fair, and sell it. Right.
That's awesome.
And we learned a lot, but it was, so when you think about guidelines and rules, we haven't changed any of them in 75 years. Now, does that make any sense?
Not materially, anyway.
Not any material change. Maybe
we made them worse.
Yeah.
We made them worse, I think.
Yeah. So how does Finance of America kind of change that, right? For a company like us that are looking at different partners, how is the underwriting different?
Yeah, it's got to be materially different, right? You got to have your own set of guidelines and rules.
Yeah.
And the investors have to buy off on those.
Right.
Because the investor's not the federal government. And everybody's got a view of agency guidelines. So what we do is we take that and build a base of investors who trust our rules and our guidelines so that I could offer those to you.
Yeah.
And then the product is materially different, right? Because it has a little higher coupon because we don't have but it's not because of credit. It's because the government doesn't back it.
Correct. Makes it a little bit more expensive.
Be worth the squeeze.
Right.
Yeah.
Yeah, that's interesting. So for a company like us, we've shied away a lot of times from doing what you would call non-QM for some time. And a lot of that is based on risk. We didn't want to be held. We don't want to be kept holding the bag at the end, right? Yeah. Where we saw that kind of happen in 2008. How do your products stack up, and how was your process for a company like ours to run a loan through? Because that's another problem that a lot of these companies have that did non-QM. The actual process of getting the deal done was very arduous.
That's the process of a lot of places that are QM
you guys,
too. It's
you guys
just
probably,
the process across the industry.
Yeah, you guys will see probably, I don't know, 20 reps that'll come in from all these different companies, and they'll all come in offering a niche.
Yep.
Yeah.
They'll say, I do.
They have to.
Right. Yeah.
Yep.
Well, and they're all brokering to some extent to some place because very few securitize.
Correct.
And do their own product. So the first thing you want to do is make sure that you're dealing with somebody who actually has the rules. Right? Because then we can make decisions, because every loan is an exception.
Every loan.
Yeah, because you basically got a set of guidelines, and I've got them here, and then your customer shows up and he's got one little niche thing that's different.
Right.
So the question is, can you put that in the pool? And you have to make that decision fast, because if we take it through the normal mortgage process, we'll drag you behind the truck for like 3 days. Yeah. Right. So I think what we've learned, well, I've done this, right? So direct access, the product. So on the flip side of that, I've got to make sure that the underwriting rules you understand, but I'm guaranteeing the first deal that Brad brings me or Sal brings me are going to be different than my guideline. Something.
Yeah.
So I've got to be able to tell you, I can do that. Right. Then you finish it. And then you have confidence that I'm going to buy it if you close it. If not, you want me to close it or treat you like a correspondent or a non-delegated broker where you're doing it yourself. Don't put it on your warehouse line, right? Let us do it so that you don't take that risk.
Right.
And then I think the next thing is, and what we find is that the originators are all over the place in terms of their understanding of what the product can do.
Yeah.
So I've got to give you scenarios on, yes, you can do this, so that you can then originate it, go find a realtor and sell the house and bring it in, right? And if it's a refi, right, it's generally how much cash out can I get? I've got some business that I own. Like I say, the guidelines and rules have to fit the dentist and the doctor that own their own practice and the Uber driver on the right? And they're totally different. But when you create those guidelines and rules around, I think you want to, because you guys want to make sure that it's sustainable and that the customer gets a good loan, right?
Correct.
And I think what happened in 06, 07, and 08, two things, right? You had interest rates that were going up, and you had, and so LTV, and then we'd had this massive run, and the average loan amount was lower, but the average CLTV combined was at 100.
Yeah, everything was 100.
Today, your average CLTV is probably 75 on these. FICO scores are high. Equity's in the deal. The problem are income and assets.
Yeah.
So if every deal's an exception, so you write your own guidelines, right? And you're getting investors to buy into these guidelines, but then every deal's an exception. Every deal is not going to meet your guidelines. How do you make that decision on yes or no to the exception? And how do you get your investors to buy in, knowing that all these pools are full of exceptions to your guidelines that you've got to buy into?
Great question, right? I think so. Generally speaking, the exceptions cluster around income and assets. So we broadly get our investors to say they buy our guidelines and give us the authority to do that within a range that we do.
Got it.
And then what we do is just make sure that as they cluster, we take exceptions and make them our guidelines. Right. So we're constantly reiterating the overall set of guides so that when I present it to XYZ, so if I'm selling loans to the state teachers retirement system of Michigan, they can have confidence that we underwrite to that set of guidelines.
Well, yeah, it's not necessarily like Fannie Mae where an exception means it's not sellable, right? No. I mean, you're essentially just creating a pool, and your goal is to make sure that there's not a turd in it, essentially, right?
Or not too many turds.
That's right. And we want loans that pay. We think that there's enough disruption in what's going on in underwriting and in home price appreciation, and then just the process of trying to get a loan today, that's a problem, right? Especially a purchase loan, because I'm competing. We've never competed against cash.
Right.
Ever.
Right.
And we've never competed against no appraisal. And we've
Right.
never competed against, sort of these, you've got probably most of America affected by the pandemic. So they have some interruptus in income, right? Everybody.
Yeah.
Right. So, and now you got the gig economy.
Yeah.
And so I think if you really think about it, and I'm going to take you back. So my view of it is that I think we've got it wrong in the way we think about it. The government tries to make a loan in old guidelines to a primary owner-occupied occupant, single occupant. That's the guideline. I think the guidelines should be built around multiple occupants and look at the single-family residence as more than just a residence, because it is. You're working from home, you're renting the home, you've got all kinds of things going on with the primary residence. It's changed forever.
For sure.
We're trying to build, not only are we trying to take the old income and asset guidelines and fix it so your customer can get on, but we're trying to figure out whether it's ADUs, whether it's manufactured housing, whether it's just like if you check one of the coolest products that we offer is a product we offer through Silvernest, a business that we own. And Silvernest finds housemates for homeowners.
Border income, to get border income, right?
Seniors, right?
Yeah.
What do seniors need? No payment, income.
Yeah.
But you want to make sure that the tenant is somebody that is like your son or daughter.
Right.
Right. You've got it. So we've built an algorithm around this, and then we find the tenant so that you can use the space.
Wow.
And then the question is, in ADUs or in anything else, you guys know how hard it is. We, as an industry, we are terrible at giving customers income.
Yeah, when they're getting it.
We're great at giving them, finding their obligations.
Yeah, that's a very true point. I mean, we strip away income all the time. We strip it away, right? We don't.
You even, and the hardest customer we find is the paycheck stub guy.
Yeah.
Why? Because base pay has gone like this.
Right.
And everybody's stacking on top of base. Bonus. Okay, well, is that 2 years? Do I calculate it for 5 years? Do I take your bonus? How long have you had it? When do you get it? I mean, Are you kidding me?
Yeah. Yeah.
We spend all of our time on the traditional things that should be a layup. So I ask, and then people always ask me like, well, okay, is it sustainable? Is it not? Okay. A consumer buying a house, is this the best day? Things are really good today, right? They've got a job. They probably got the highest income that they've ever had. They may be married. They're happy. The kids are in. It's a beautiful day. Well, stuff happens after that, right?
Right.
But at the end of the day, it's that income that we should qualify you on. And then the question is it sustainable? Well, who knows, right? You could lose your job in 5 minutes.
Right.
But,
that is the question. I think that's why the guidelines are still so old school, is because they're risk averse, right? They're trying to eliminate as much risk as possible.
They're built on, they think the history of your income is the best predictor.
Right.
And it's never been proven that DTI is correlative to default at all.
Correct.
What's correlative?
Brad's Brad's getting uncomfortable.
LTV.
No, I'm not.
LTV
I'm actually really interested in this.
And credit score.
So my question would be to you, are you compiling all this data to make a case to the GSEs to change their guidelines in the future?
I'm never going back to the GSEs because they will never change.
You're out on that. You're out on expected. You just don't expect that to happen.
They can't give you different master agreements. So depending upon whether you are United Wholesale or you are Omega, you get the same thing. And I'm guaranteeing you, given where we are with DEI, ESG, RSG, all of that, it's all going to be about normalizing it and more affordable housing with the government.
Agreed. So that opens up the door for companies like you that are securitized to be able to fill a lot of niches, right?
Now Paul, Sal, and Brad begin to sell loans to Finance of America instead of whoever.
Because
will other people follow us? Maybe.
Yeah.
But you got to be a securitizer, which eliminates almost all of them.
Yeah. Are there any other like companies doing what you guys are doing in the scope that you're doing it?
Very few. And the reason is that they don't have capital. They don't have this team. I mean, I've got 100 and some people in the securitization group.
Wow. And
then when you look at, and I'll give you a really good example of how to do it, right? So I wonder if I've got a tombstone here.
You got a tombstone?
Well, we give tombstones on every deal we do.
Yeah.
Right? They send them out to us. It's like a deal marker.
Yeah.
Right? And, hey, you did this. So we just did Hunter's Wood, we used Winnie the Pooh. So I've got this deal where I've got Winnie the Pooh's head going into the transaction. Why? Because the agencies begin to orphan non-owner occupied.
Yeah.
Right. So the first thing they did was they said, "Oh, we're cutting it back from whatever to whatever." Yeah. Right. So you guys know, at least for us, I would say non-owner occupied transactions, fix and flips, and all of that's probably one of the most material changes that have happened over the last decade.
Right.
And you've got more people owning single family residences, including Zillows, who just reversed engines yesterday. And all these different people who buy single families, right? Yeah. So you've got, but we are doing close to 20% of our volume in non-owner.
20%. Yeah.
Yeah. That's a ton of loans. Yeah. So we did the first securitization. So you had to create a structure where you could put an owner occupied in with a business purpose loan, the fix and flip loan.
Right.
And we did that. But you have to structure it. You have to have the investors to buy it, and you have to price it, and it has to be competitive to you three. Yep. It has to get to the street.
Are the investors happy with the product? They're gobbling it up?
They are. In fact, we securitize the hardest product in America today in HomeSafe. So we have, we've got probably almost 7 or 8 years worth of jumbo reverse. Think about that. So my investors are buying jumbo reverse. So when they sort of look at a flex loan, they go, "Whoa, let me look at that." It's a lot different.
Right.
But they are used to us. They trust us. We've got a long history with the investor group. And so it's easy. I wouldn't say it's easy, but it at least is consistent where they can get used to your rhythm and your securitization. The other piece is the data and analytics that you have to provide them, because in that deal, there were 57 structures in a securitization of $300 million. So you have investors buying 57 tranches, and you've got to have the expertise to be able to find, because there's 57 different investors,
right? Potentially,
right? Now they do cluster because some want AAA, some want the bottom piece, some want the residuals. So it's a whole business line, but my goal, it only works if Brad can originate a loan easier, better, faster. So one of the questions you asked is, how do we do it? I emulate the agency process for you.
Okay. How do you do that? How do you emulate it?
Well, we use, instead of taking 50 sets of guidelines and rules, we have one set, right? And then we emulate LPDU. I might take the LAS and finding and add 5 things instead of having taken you down, meet a manual underwrite.
Right.
Okay, that's I don't want to do that. Right? That's terrible. It's a terrible process. Maybe today, one of the things we're considering is, how do we do it if appraisals are so hard to get and they're so expensive and everybody gets, how do you do the appraisal process better?
Yeah.
Well, we own an appraisal business.
Right.
So why are we just not using a AVM with an inspection?
So essentially, like, it sounds like you could use UWM's system. The main difference is the fact that the income is being calculated differently, or the assets are looked at differently, right? Essentially, you're running DU.
We could. You do.
Yeah.
Right.
There isn't an originator that doesn't do it this way.
Right.
So the question is, why would I take you off that track, right. Of LP, because you're already doing it. Now, what we find is that most of our brokers have crappy LOS systems.
Oh, yeah.
Right? They use Point, or they use Encompass, or they use some system. They don't even give a hoot.
They all suck.
They all suck, Bill. They all suck.
Yeah.
We're lucky we found a good one. Yeah.
Which I think once you find your system and your process,
yeah,
you want to be able to use the same process and come to me.
Yeah.
You don't want to have to change your entire operating system to try to do these type of loans.
100%, Bill. That's one of the biggest hurdles that we've had is we have a really, we like our process, right? And we don't want to mess with that process. I don't want to put, we're running rocket fuel, and then all of a sudden I put in, some E85, whatever it is, right? So that's the whole thing. So you guys are actually aware of that, which is very smart, Bill.
Well, and I built CV, right? So I built Cloudberg up. We use a point of sale system that sits on top of a rackety old LOS.
Right.
Right.
Yeah.
And so we're able to lift, like you guys, right? We're able to lift our originators so that they live in a marketing and what I'm going to call a marketing and origination portal, not a LOS.
Right.
Right.
Yeah, that's true. A lot of people call it the LOS, but really the LOS ultimately should, and we can get real technical. I think we'll bore the audience, but LOS situation in our business is really kind of funky. It's one of the most important parts of our business, and there isn't a great solution out there.
No, and the real challenge has been that there's about 50 integrations to this railroad track, right?
Yeah.
So whether it's docks, pricing it, I mean, if you really think about it, it's just stupid, right? So what United Wholesale,
it's all stupid.
What United Wholesale and some of the other people have done is they built a portal that allow you to upload, so that you can use Calyx Point or some other system.
Just like the 3.4.
It's another dog shit system.
Yeah. But
instead of giving us a good system, they say, we're going to have our system. You use whatever you want. That's all dog shit.
Yeah. And what we should do is help Brad and Sal originate. So my view of it is I should give you a system that allows you to get closer to your customer and do the loan easier.
Yeah.
On the back end of that, it should be agnostic to you, whether it's an agency loan or not agency. It's a 30-year loan.
Right.
The customer is looking at a 30-year loan. They have no idea they fit or don't fit. And every customer thinks they fit or pray that they do.
Right.
In some facet.
Just like they all
think the moment you meet them, Brad knows the moment he meets them, their Achilles heel.
Always. Yeah.
I mean, you see the customer and they give you their stuff and you go, oh.
Yep.
Now I've got to figure out, how do I process this?
Right.
Okay, come on. That shouldn't be, the question would be, okay, it presents higher risk. How do I do that? I'm going to price it differently and get it done, go on to the next deal. Because our job has to be to give people a sustainable housing that they can pay for, right? And give them a flexible lending solution that sort of fits the lifestyles. And forget, because the current guidelines are they are archaic in the form that it's a one size fits all instead of creating a flexible lending solution that gives people a multiple options to fit. And I think when you think about it, I probably spent 20 years. And one of the more interesting things that when you do a post-mortem of that, right? When you go in and then analyze your product for 20 years, what do you find out, right?
Right.
And you find out that people you have default on one side, severity on the other. The lower the LTV, the less you lose.
Yeah.
It's not like rocket science.
Yeah.
And then on the other side, the question is, what causes default? What isn't DTI?
Are your
So why are we
default
focused?
rates? Are your
There's so many
default
things
rates higher than?
No,
No, they're not. Right?
there's no default. Zero. Right? It's like, why? High FICO, low LTV. People just have, they've been damaged some way to our guidelines. They don't see themselves as having an issue.
Right.
We have the issue as an industry because we try to put everybody in that box.
Yeah.
So
go ahead. So
I was going to say, if values shift, right, and LTV now starts to rise in some way, which again, like, what do you mean? Like as a consumer?
No, I mean, I think you got a consumer and you got consumer. You only got three people, right? You got consumer, lender, investor.
Mm-hmm.
Yeah.
So what's the consumer generally is late to the party.
Yeah.
Right. Always. And they're buying. So they're excited now. They're going to go out and buy, and they're buying at the height.
Yep.
The lenders are stuck in the middle because their old guidelines don't fit and things are pivoting. What do we do? And then you got investors on this side that are government and private. You got private loan. You only got two options: private loan securitization and government securitization. So at the end of the day, I think what you have to do is you've got to build something that's sustainable, and that has to be a focus. My focus would always be on how have they performed in any cycle, if you can see it, to the customer, and do they have any staying power?
Right.
At all. And what we found, I was going to say in our post-mortem over the last 25 years, I'm going to go out and I found two customers. Always. I found what we call the affluent customer, and we called them the M&A, the mass non-affluent.
Mm-hmm.
These people have under $100,000 of income, under $100,000 of assets. And we have two sets of underwriting guidelines, and we underwrite those people differently.
Mm-hmm.
That's how we do it.
That's the secret sauce.
That's the secret sauce.
That's
right. And when you think about so when you're looking at, so what's the difference? These people have cash and they have low LTV. So they're not really a problem. These people want and need down payment assistance.
Yep.
I mean, how many bond loans we do 2,500 different bond programs. Wow. It's like we are doing loans today with a 30-year fixed that have a bond behind it already. And we do VA loans with no down payment and FHA loans with almost no down payment.
Right.
So what have we learned? We've learned that absent fraud in the file, fraud in the file, 92% of consumers always pay.
That's pretty good.
But
8%. I mean, even in 03, 04, 05, 06, 07, 08, what is the percentage of people that actually paid? 92%.
That's pretty good.
8% went into default. The problem is they just went all the way to foreclosure.
Yeah.
Which they normally don't do.
So, but in the, all right, obviously in the affluent low LTV bucket, you're not really worried about that, right? But let's say someone, like VA, for example, even if they have 800 credit score and, a decent amount of savings, if values flatten or drop at all, I mean, right off the bat, someone who puts zero down is underwater, right? If they need to sell. So
my point would be they've been through that before. 92% of the people pay. Even
in those scenarios.
Yeah.
Because they don't want to lose their house, dude.
Nobody wants, absent fraud, you don't want to lose your house. When you lose your house is when you get divorced. When you lose your job.
Yeah.
When you overextend your credit and when you do something stupid.
Yeah.
With the money.
Right.
And those are the five. And the fifth one is medical. And we do not, where we really should focus our attention in underwriting is in insurance and medical. Yeah. Because you have to have benefits and you've got to have insurance because you got catastrophes happening everywhere.
Yeah.
And we don't do anything around that.
Can you imagine advertising that? No income, no asset. As long as you got insurance, we'll do your loan.
Well,
Yeah.
I can see it. The emails coming in my inbox already.
Yeah.
If I was in Florida, if I'm in California in a fire district,
Yeah,
if
dude.
I'm in where? I mean, you're in Michigan
Anywhere.
where water is like gold.
Yeah, Michigan's actually really safe. We got the best. We're gonna be the next Florida, dude.
Don't
Global
ever say
warming and everything.
You guys
We got
are
the
as bad
beaches.
as Ohio, so don't even go.
Bill, we're running out of time but I'm enthralled by your knowledge. I'm enjoying this conversation so much. I did want to hit on your take on what you believe the customer journey should look like. What should the client experience feel like? How does that translate into like what you guys do on a daily basis?
Yeah, it's such a great question, right? I think we, as an industry, I'm going to say overall, I think we're product centric, and we talk a little bit about products, and we're not really customer centric. Brokers and advisors and my customer want us to be customer centric. So the journey should be at closing. It opens a relationship, and you should retain servicing, give them rewards for doing things well, and keep them connected. Because at the end of the day, we're more than mortgage, right? If we don't do this, Paul, you're going to lose your customer to Lending Club. You're going to lose your customer to SoFi. We're going to lose our customers to banks and to other folks. So you have to have other products and services that sort of fit their journey. And you have to have data and analytics to be able to predict before they even know what they're going to do next. And you can do that. And so the journeys, and then the coup, I think for us is you have to treat them differently when they come back.
Yeah.
And we don't.
That's the key.
We treat them worse. I mean, I have customers who've done 20 deals with loan officers, and they just say every time who are you?
But you're treating them different than a stranger would, because there's already a bond there. Right. Yeah. So there's a perception of difference. Exactly. There's a perception of a different treatment, even though it might be worse. Doesn't matter.
If I could somehow, we want to help people make really good decisions when they buy a home and as they manage their equity. Right. So I think we need to change the model a little bit to where the customer, it's more like a professional services arrangement.
Yeah,
to some extent. That's what it is.
We're advisors, and you've called us advisors this whole time, Bill. And I believe in that. I believe we are mortgage advisors. That's what I put on our business cards. Right? We are advising as much as anything the proper, potentially the best possible program for our people. Right?
And I think the real interesting piece is that I would say for 95% of Americans, the equity in their home is their financial nest egg.
Correct.
So why are we not the preeminent equity advisor?
Correct.
You want to do something with your equity? The other thing is we suck at really trying to help people, because equity isn't just home price appreciation, as Sal said.
Right.
Right. It could also be, look, you got pay one extra payment a year, pay it twice a month.
Right.
And pay it off and save $300,000.
We're managing the equity. We're managing the debt.
Sal's job is, so if I'm going to do 100 LTV loan to a customer, a new first-time mass non-affluent home buyer, right, which is riskier.
Yeah.
Right?
Yeah.
I have to have them pay the loan differently, faster, so they can build equity quicker.
Right. Add an extra payment a year. Right.
That's it. Or just say make 2 payments. They get a paycheck.
Yep.
Pay it twice a month.
Yep.
If you pay it twice a month, it pays off in 18 years.
Correct.
Right. Correct. So why are we not doing that?
Correct. That's the true advice that you're talking about.
Exactly.
That's the true
advice. You guys are in the hood. You're in your community. You know the people. They trust you.
Right.
And if I'm doing a SWOT analysis on an advisor, basically what I tell our people is my job is to help keep you relevant to your customer, so that you don't lose that customer, because everybody else is trying to get a shot at it.
But everybody else is coming at them with the same shit. That's
we're
a service industry, right? Everyone has, like you said before, everyone's got a 30-year loan, and the customer doesn't know if they fit or don't fit. They just know they need a 30-year loan, and they think they fit everything. So
I think the problem
your service is what stands out. So you have to be able to do those extra steps and be an advisor, because they can go anywhere and get a 30-year loan. Well, at least in their head, whether they can or not, it's a different story.
To Bill's point earlier, right? Like, a lot of people aren't trained or know what they're doing with the products as well, right? So they just figure and assume, you can put 3% down on a 30-year loan, and here's the lowest payment possible for you, right? And it's not necessarily a service industry for most. I mean, those who get it understand that, right? It's a sales industry for the rest, because they think that they can come in, they can make a lot of money doing this. All they have to do is get people to, quote unquote, do loans, right? Versus, I talk to people all the time. Hey, why are you going to deplete every single dollar you have?
Yeah, it's a bad idea.
Buy this home, you should probably put 10% down as opposed to 25 or whatever, right?
And so one of the businesses that I built, that when I sold First Franklin to Nat City, they and Merrill Lynch, one of the things that they liked about what we built, we were all TPO. So we were doing this for brokers, right? We were helping. So what I should do for Omega is not just, I got to look at your business and say, I want to help you grow your business, not just give you loans. People can do that. How do I help you grow your business? It's marketing, it's sales, it's making a consistent process, it's hiring, recruiting, it's scaling, it's growing. And so the idea, I think, when you start building a business around a product, you lose the customer-centric nature of thinking that because the sale begins when the prospect closes.
Yeah.
And I got LOAs all over. I got loan officer assistants all over America today that don't do anything except nest a loan and try to get it funded.
Yeah, that's awesome.
And that's just
That's awesome.
Right. I got what should the branch do? What should you do? You should have a database.
Yep.
The database should know all your customers. Your customers should be tranched. You should be looking at those journeys. You should know this one's 28, this one's 32, this one's married, this one's not married. This is the journey that I'm putting them on. And we should know exactly what that journey is for each customer. That is customer centric.
Agreed. Which is hard to do, Bill. It isn't easy to do, but
we don't have database management. All your stuff's stuck in Encompass. You have to pull it out of the LOS, right? And then you got to do something with it.
Yeah, it's not easy.
Well, I can't do anything with it. I have to go get it again.
Yeah.
Really?
Yeah.
I mean, come on. We got data sources. I mean, we got cryptocurrency. We got all kinds of things that are happening that are exciting. Not in mortgage.
Yeah. Yeah.
Well, at Finance of America, it's pretty exciting because it's about to change to where we can win.
That's awesome. Bill, we're running out of time, so we want to get to 3 questions and then we'll get you out of here. Okay. Yeah, we are way over time today.
Sorry.
It flew by. No, Bill, I want to bring you back on. There's so much more we want to talk to you about. This is interesting. It's enthralling stuff. So thank you again.
Well, it's different, right? It's not the same everyday situation.
It's very enthralling. I love it. I love talking shop about this stuff. But first random question, Bill, is what scares you?
Oh, not much, right? I've seen a lot, been a lot, done a lot. And I think in mortgage, what scares me is what I'm going to call the incumbent nature of mortgage, right? We just don't change, right? And change gets forced. Mm-hmm. Personally, I think it's trying to help. America seems to be suffering from big social challenges, right?
Sure.
Housing solves those. Why are we not solving them?
Yeah.
Yeah. The federal government holds us hostage.
Yeah.
On what we can do and can't do, right? At least.
Not me.
Now, Bill's
I can go finance a manufactured housing guy in your neighborhood, or I can help try to build. I mean, we can ADUs, even our ADU. I mean, I have been talking about how to use property.
Can you just explain what an ADU is, just to be?
It's an auxiliary dwelling unit.
Yeah.
And so it's basically taking, whether it's a garage or a detached garage, which, you guys are in Michigan for crying sakes. They all should be attached, but they're not. And so you take that garage and you create a rental unit.
Yep.
Out of it. You share the income.
And in today's world with Airbnbs, those are could be really profitable.
Airbnb, and most states have now changed their what they used to call this granny flats ordinance, where you couldn't improve unless you had, setbacks and all these different things. They've basically blown through that and said, we've got to help solve affordable housing. So an ADU, in my view, is one of the best ways for us to be able to help people solve housing for their family, for themselves, and for others.
Yeah, that's awesome.
Yeah, because you get an ADU and try to sell that to Fannie or Freddie.
That ain't happening.
Generally, is not happening.
Well, they won't let you. You could probably sell it, but they won't finance it.
No,
and they won't give you the income from it.
Right. They won't. They will not.
And they got to make sure
square footage for it if it
wasn't
permitted.
Square footage for it. They got to make sure
it's a whole thing.
Permits were pulled from. It's a whole.
It's a whole thing, Bill. You just opened up a can of worms.
How many questions would come from an underwriter?
Too many to be worth it. Too many to be worth it. To be fair,
you find out there's an ADU. You just added 4 weeks onto your process. And
you're not even going to bring it up. You're hoping the appraiser doesn't see it. So. Bill, next question is, obviously you've been in the industry for a long time. You've done a lot of really, really interesting things. Who is doing some stuff right now that impresses you in the industry?
Besides us, obviously.
Yeah, I think the broker is.
Yeah.
I think the broker's doing some things that are exciting. It's all over the place in terms of what they do.
Yeah.
I think in some respects, SoFi is.
Yeah.
I think
they're
they
doing
are
some
in
interesting
terms of
stuff.
Marketplace.
Yeah.
I actually think that in technology, you see a bunch of technology things. I think there's some cool stuff happening in how to use data in the analysis versus, wouldn't it be great if we could take what the industry calls this old PIW, which they don't even want to talk about it that way anymore. But if you could just make an approval, you've seen the customer, you've seen the house, you've seen this, and so blah, right? Versus having to go all through that process. So, but I think in ancillary businesses, there's so many exciting things going on, and we just have to be able to take advantage of it.
Yeah. If you could change one thing about the industry, what would it be?
I think I could change the comp so I didn't have to pay a loan officer just on the closing of a loan.
Oh, interesting. So how it performs?
I could pay them on the annuity of the servicing. I could pay them on other products and services. I could pay them, instead of having this what I'm going to call, and I can't pay you differently on products.
No. Right.
Right. So I would change comp to where it makes sense.
That's interesting. I've never heard anybody
say
it
relationally. Long-term value of the customer instead of closing.
That would be very
it definitely incentivizes the right behaviors on the front end.
Well, you would hire differently.
Yeah.
And you would, as a loan officer, you would sell differently. Yeah, absolutely.
Well, you work as a financial advisor.
Yeah, you'd be an advisor.
Yeah,
and you got a big pool and a book, and as long as they're retained with you, and that
there's a residual business there. That's interesting.
We would be partners.
Yeah,
we would be on the same side of keeping the customer.
Full partners at that point.
Yeah. Instead, we sort of feel like we're, if we retain servicing, then we have investor requirements. If for you just have a customer. You see that as your customer. Right?
It sounds like such a radical proposal, a radical change, but
it's so simple.
It's so simple, and it makes so much sense.
I've never heard anybody bring that up.
I don't see it happening.
Get to work on that, Bill.
Makes sense. Yeah.
Can you make that happen? I mean, you did all this other stuff.
I am a lawyer by trade, right? So part of it is you have to think this through, but part of it's compliance, right? And dealing with just what we have to deal with the regulatory stuff that we deal with. And the other part is, shouldn't we probably get a signed agreement with the customer to be their advisor?
Yeah.
Even if it costs nothing.
There should
even if it costs nothing.
Yeah.
So I'm going down that path, dude.
That's awesome. I love that.
No.
I love that, Bill. I mean, I love the way your brain works, dude. It's really interesting. I want to bring you back on and dig in some more. This was more of like
let's talk about lifetime at some point. Let's talk about lifetime value of you wanting to be an advisor and how do we make that work?
Yeah.
So we're not just tethered to this 30-year, did I close a loan? Did I close a loan?
Yeah.
How do I keep that customer and how do I get paid?
Yeah.
That's the thing that's important is if we can't pay them, they won't do it.
If we had a residual income, I'd be real happy.
I think all of us would be.
I would be very, very happy. Bill, tell the if we want to get signed up with Finance of America, what are the steps that we've got to go through? Who do we get a hold of?
Just any of our reps, right? Any rep would sign you up, and you're signed up across my channels, right? So it's whether you're fix and flip or you're reverse, or you don't have to go through 3 different approval processes.
Yeah.
But it's pretty simple. If you're a NAMBI member or you're an AIM member or all of that, it goes a long way, right? For us, because we're big proponents of helping you guys grow your businesses and what you guys want to try to accomplish. But just any rep.
Yeah. What are the requirements for? Do you guys have requirements that?
Yeah, a little bit.
Yeah.
Years in business, experience. We're looking for people who know what they're doing. Yeah. But there's no real big, huge net worth requirement. There is as you move to what I would call NDC or correspondent.
Correspondent, right?
And I asked each of you, how do we help you grow? This is where you are. Is this where you want to be? You want a warehouse line? You want to be a correspondent? I mean, I think all of those things are what brokers. When I started my business, I was just like you guys. I was in the basement of a Victorian across the street from law school at Santa Clara, and that was First Franklin. It was on Franklin Street.
That's why you call it First Franklin? Come on.
Yeah, I'm not a marketing whiz. I then had an online business. I called it First Street. I'm an idiot.
I love it. Well, on that, Bill, listen, we appreciate your time. I can't thank you enough for taking some time with us. I hope the audience got something out of it. I know we did for sure. So anything you want to leave us with before you go, Bill?
I just really admire what you guys do, right? And I will continue to watch. And if I can be helpful to you guys in any way, no matter what, right? You can just reach out or call or ask. You have a friend, and I would love to be able to just watch your business grow.
I love it, man. I love it. Well, we'll talk soon. I'm sure we'll be in touch. Bill, thank you so much for doing the show, man.
Appreciate it.
Appreciate it.
See you later.
See ya.
How awesome was that guy?
Yeah. It's kind of like a breath of fresh air into the normal stuffiness of Fannie Mae, right?
Yeah.
I mean, we talk about it all the time at the office, right? We talk about, man, how stupid is this guy? Like, there's no common sense.
Crazy.
We talk about it all the time.
He's got 250 grand in the bank and is buying a house.
Makes me want to get signed up with them. We're not even really signed up with them. I've talked to them before in the past about getting signed up with them, but they do some good stuff, man. They're backed by some pretty big boys, and the fact that they're securitizing their own deals, it's kind of interesting, right?
Mm-hmm.
Yeah. All right, guys. Well, that is awesome. Thank you guys again for listening to the show. For those of you that have stuck around, thank you. Please like, subscribe, share, and leave us a review. Go to irepodcast.com. Go to Facebook.com/IRE podcast. You can go to YouTube or anywhere that you consume your podcast listening pleasure. Thank you again. We'll see you guys next week. Bye-bye.
Bye-bye.
You've been listening to Inside Real Estate, the nation's top real estate podcast. Don't forget to follow us at irepodcast.com and everywhere where podcasts are available.